This was actually a good trade that we took. That was on last Wednesday, and this trade went into our direction. This trade was sent to Telegram people, and this was the signal, and this was my trade entry, and this was price going into my direction. It was sent to Telegram people. You can join. That's Prime Pips community, okay? And people made money from this trade. Someone later DM me that this trade took him out before going into his direction, okay? You can see it was a successful trade, but I don't know why it took him out. That's when I realized that a lot of people are trading with fixed stop loss, okay? Which is wrong, because every currency pair has its own true range, all right? For example, let's say you are trading GU, okay? And you are using a 30 pip stop loss for GU, all right? Anytime you move to, let's say, USD JPY, you can't be using this 30 pips there, because when it comes to the average true range, USD JPY has a higher average true range than GBP USD, okay? So that is how it is. Some currencies has a higher average true range than others. So if you are using a fixed stop loss for all of them, you'll be taken out of trade a lot of the time. Then trade will go into your direction. I'm going to show you how to place a proper stop loss so that you won't be taken out of trade, and then trade will go into your direction. First of all, let me start from USD chef, okay? For the example, then we come right here. So this, let's say this is a pair of USD chef. We are going to use an indicator right here on TradingView called the ATR indicator. The ATR indicator measures amount of time and then the volume and the volatility in the market to show us the areas where we can place our stop loss and won't be taken out, okay? So that is the indicator we are going to be using right now in this video. So what you're going to do is go to your indicator section, this area here, the top here, press there, and you're going to type in ATR. It's going to come this indicator right here. I've put it on favorites, press on it once, and it's going to appear on the bottom, okay? So this is the ATR indicator that we're going to be using, all right? When you look at the ATR indicator, look to your left side right here. You know we have some value here. I mean this area, look to this area. That's what I'm talking about. We have some value here, okay? Take your mouse cursor from the screen, and you're going to see the value that the ATR is presenting. So we see right now we have 137, okay? So on the 1 hour time frame, the ATR is showing a 137 value. That's on a 1 hour time frame, okay? So when you go to the 15 minutes, it's going to change. 15 minutes is showing 78, okay? So this is what we are going to be using for our stop loss, so that we won't be wicked out. We won't be used as a liquidity, or we won't be taken out of trade, and then trade will go into your direction. So what we want to do first is we're going to use some formula right here. Watch this video carefully. If you are new here, don't forget to subscribe to the channel. And if you have any question, let me know. So this secrets we are going to use is we are going to use some candlestick and then the ATR. That's what we are going to use right now in this video, okay? So how are you going to do this? We are going to use the candlestick and ATR to find this, okay? So let's say we have identified this trend to be a bullish trend, all right? And we find out that there is a low here, there is a high here. We are expecting for price to come and create a low and then go up and create a high, okay? Because that is how price move. Talking about price action, okay? This actually is a break on retest of price. You see there has been a reaction right here. Price reacted here, and there has been a break, pull back to price, okay? Price has been reacting to that zone multiple times. That's what I'm talking about, okay? If you don't understand market structure, go watch my other videos. So now we are expecting price to push from here to the upside on the dollar chef, dollar Swiss franc, okay? So we are trying to take a buy trade right here, okay? Where are we gonna put our stop loss so that we will be taken out of trade? If you are a day trader, you need to scale down to the smaller time frame, okay? If you use the higher time frame, you are gonna be getting a bigger ATR, which is gonna give you a higher stop loss, okay? So if you're a day trader, you go to the 5 minutes or the 1 hour, or the 5 minutes or the 15 minutes to take your ATR value. So now I'm going to the 15 minutes for my ATR value. On the 15 minutes, what are we seeing on the ATR? On the 15 minutes, we are seeing a 78 value on the ATR, okay? So ATR value is 78, okay? 78. And then what candlestick are you going to use? We're going to use the candlestick, the confirmation candlestick. And this was the candlestick for the confirmation. This was the candlestick we saw before we are trying to take this trade. Either price is in your order block zone, fair value gap zone, or whatever. The candlestick you see for the entry, that is the candlestick that you're going to take, okay? So the next thing we are going to do is we are going to measure the entry candlestick. This was the candlestick that was formed before we got the signal for the buy entry, okay? So we are going to go ahead and measure that candlestick that formed. So we're going to go ahead and measure this candlestick that formed before we trying to take this trade. So I take my ruler, measure from the top to from the bottom to the top, or wherever you can measure it from. 22 pips stop loss candlestick. The candlestick is 23, okay? So we put this one here, 23. So what is our stop loss going to be? It's going to be the candlestick plus the ATR indicator. This one is going to give us 11, 1. This one is going to give us 9, making 100, okay? So our stop loss is going to be 101 pips, 101 pips. So we put our stop loss at 101 pips, okay? This is better so that you won't be taking out a trade and then price will later go into your direction. That's why I'm saying that if you're a day trader, you go to your smaller time frame for your entry. But if you're a swing trader, you just have to take your trade from the bigger time frame. Okay, so let me put the stop loss 100 pips. And then the take profit is supposed to be 200 or 150. So take profit somewhere around here. Okay, 200. All right. So this is how you can be able to place your stop loss and won't be taking out a trade, and then trade will later go into your direction. You can see. All right. So let's find out for a sell trade. This is for a buy trade. Let's find out for a sell trade. And let's go for, let's say, different pair. Like let's try and use gold for the example. Okay. So if for a day trader, I recommend you to scale down to the 15-minute. This trade, we took it on the 1 hour. If you're a day trader, I recommend you to scale down to the 15 minutes and the 5 minutes so that your stop loss is going to be small. Or let's say your stop loss is going to be something like this, okay? If you use a bigger time frame, your stop loss is going to be wide, okay? You have to scale down to the smaller time frame, measure the entry candle, and then you take the ATR. If the time frame is small, the ATR is going to change, okay? So this is where we took the buy, and stop loss was somewhere around here, and take profit was twice the stop loss, and this trade was still a successful trade, okay? So this is how to place a proper stop loss so that you won't be taking out of trade and then price will later go into your direction, okay? If you have any question, let me know down below. I'll do and answer you. Don't forget to subscribe to the channel and then follow me on IG and Clinton and like the video. I'll see you in my next video.